So we continue from these allowable expenses, and we have been told that we have depreciation. So let us take the depreciation now. The first depreciation we have here is equipment. They said the balance in respect of office, that is additional information 3. The balances in respect of office equipment are after charging accounting depreciation of 28,250,000. So we have depreciation of equipment which amounted to 28,250,000. So we come here, we say that. So that is not all. We also have depreciation of, I think that should be freehold. That should be freehold. The freehold property was purchased on October 1st, 2021 for 263 million and is being depreciated for accounting purpose at on 10%. So let's come here and check our depreciation. 10% of 263 million is 26,300,000. So we have 26,300,000 of freehold. 26,300,000. So haven't done that. We check again. What other disallowable expenses do we have here? So we're told that they pay fine. In this current liability, you can see fine there. 32,300. Fine is not allowed. It's not allowed. So we bring it here. Fine, that is how much? That's 32,500. 32,500. Fine. 32,500. 32,500. So I haven't done that. Increase in provision for doubtful debt, because we are told that the trade receivable above is shown net of an allowance for doubtful balance, that is 16,007. We'll come here, we'll see that increase in provision for doubtful debt, which happens to be how much? Which happens to be 16,750. So we say that 16,750. So I haven't done that. Let's check again. What other disallowable expense do we have? We have interest payable. Interest payable is also disallowed. That is accrued interest. Accrued interest. That is 10,000. 10,850. 10,850. So let us add everything together. Let us add it together. So then we less those income, we less disallowable income as well. There are some income that has been recognized in financial accounting, in financial reporting, that tax authority do not recognize. So we will bring all those income and then all those expenses less disallowable income. Are you getting me now? And allowable expenses. So let us first of all take the allowable expenses, which happens to be our capital allowance, because we were told that in the question, they said the balancing in respect of the freehold property. The second part, because of our time, where Bugan Nigeria Limited is in position to claim 94 million as accelerated depreciation. That is capital allowance, 94 million. So we say that freehold capital allowance So that should be 90 what? 94 million, I think. 94,600,000. Let's put it here. 94,600,000. So I haven't done that. What other? How much is that? That is 22,500. 22,500. Then remove what? Sorry, equipment. This one is equipment. So I haven't done that. Our interest income. Our interest income, which happens to be 3,250. Interest income. Interest income, which is 3,250. 3,250. So those are our what? So let us add them together. 94,600, 22,500, 94,600 plus 22,500 plus what? Plus 3,250. 3,250. Sorry. 350. 350. Then we subtract it from this. Subtract it from this guy. The addition of these three is what gives us this. So we subtract it from 311,450. Let me say that 311,450. 311,450 minus 120,350. 120,350. So we have 120,350. So we have 191,100. That is our taxable profit. 191,500. 191,100. 191,100. That is our taxable. Do we get it like that? So tax payable, rather. Tax payable, which is 30%. 30%. So we can come to this side and say that 30% supposed to be 30%. 30%. This is our what? This is our taxable profit. Tax payable, rather. Tax payable. Tax payable. So don't forget, this is 2022 November question. 2022. Second question asks us to calculate the deferred tax liability. Now, everything that is here will be what? Will be considered. Almost everything that is here will be considered because they have already included it in the statement of financial position. It has been capitalized. So we take them one after the other. We have freehold property, which is 236,700. Freehold property. Freehold property. And the carrying amount, don't forget, temporary difference is the difference between the carrying amount of an asset and the tax base of that asset. So carrying amount now, the figure that is here is already the carrying amount of that particular asset. said that the figures inside this financial position, they are already the what? They are already the carrying amount of all these assets because it has already been depreciated. Are you getting me? For the fact that they have put it inside this financial statement means that they have already subtracted the depreciation from them. Are you getting it now? Now, we will just pick them one after the other. Freehold properties 32, 236, 700. We have taken that into consideration. We have office equipment, which happens to be 205,000. Okay, sorry. Carrying amount of this is 236, 700. 236, 700. Then we have that of equipment. Equipment should be 205,000. 205,000. So after that, what text do we have? What text do we have? We have okay, we have trade receivable, which happens to be 174,250. Trade receivable, which happens to be what? Which happens to be 174,250. 174,250. Then we have what X? We have our interest received. Interest received. Interest received. Which happens to be 3,250. If I get it, 3,250. Yes. We have fine payable. Fine payable. Fine payable. 32,500. 32,500. Meanwhile, the reason why we actually brought this fine payable here is because it has been capitalized. If you see normal fine, it's like a fine that is being expensed, you don't bring it here. Are you getting me? The reason why we are trying to bring all the items here is because we can actually see them on the face of the statement of financial position. That means their carrying amount has been like it is stated, it has been capitalized, and we say that temporary difference is the difference between carrying amount of an asset and its tax base. We already have the carrying amount of those assets, but if the it is an expenses, you don't need to bring it here because temporary difference is not the difference between expense or expense of amount of a particular expense and the tax base. That is not it. Is the what is the difference because it is being paid. You put it in the bracket. Are you getting it? So we have interest payable as well, which is 10,815. 10,000 of freehold property. Tax base of freehold property. We were told that freehold property, which happens to be okay, it was depreciated 260, and then the accelerated depreciation, that is the taxable depreciation, is actually 94,000, 94,600,000. 94,600,000. So let us use our calculator. What is the cost? Freehold happens to be how much? 236,700. 236,700 minus 5. Information. They said freehold property was purchased on October 1st, 2021 for 263,000 and is being depreciated for accounting purpose of on a 10%. That is depreciation. So this is the cost of the depreciation. Are you getting it now? This is the cost of that depreciation, and then they depreciate it at the rate of 10%, which we have used that one to calculate the carrying amount now. If you calculate that 10% of 263,000 and subtract it from 263,000, you are going to get 236,000 naira. What is at the what is at the or what is inside the statement of financial position as the carrying amount? Are you getting it now? So We just need to calculate the tax base now. So we say that 363 million rather. So thousand. So our tax base like that is 168,400. So we come here. Our tax base is what? If you don't understand how we calculate this one, you can refer to my previous video just so you know how to calculate tax base and then carrying amount, please. That is very, very important. So let us come to the second. What is the tax base for the equipment? What is the cost of the equipment? Check, and then we remove the tax allowance. We're told that okay, the balance in respect of office equipment after charging a contribution of 28,000 and allowance of what? Allowance of tax allowance depreciation of 22,500. So the capital allowance for this one is 22,500. As with the office equipment, they have 205,000. That is the carrying amount. So since they don't give us the cost of this equipment, we'll just assume that 205,000 naira, as even according to the question now, it's just like an assumption because we are not given the cost of that office equipment. Just remove your capital allowance from that 205,000 naira and have 182,000 naira because there is no actually how you can do it again aside that. So we have 182,500. 182,500. Then we have what? We have trade receivable. So we come and check the additional information as touching trade receivable here. We're told that the trade receivable above is shown net of an allowance of for doubtful debt, doubtful balance of 16,750. So we will add that gives us 181,000. So bring your 181,000 here, ask your what? As your tax base 191,000 altogether. So trade interest received. Do we have any information as touching that? Any information as touching that is taxed? That is, our interest receivable should be subjected to tax. We are going to pay tax on that interest receivable, while interest expenses are liable on a cash basis. Whenever interest expenses are liable on a cash basis, the tax base of that particular interest payable will be zero. Are we together now? So that will take us to our spreadsheet. Our interest received, which is having carrying amount of what? Of 3,250, and we're told that there is no opening or closing. There is no opening balance, so we just have it back here as our temporary difference. So there is nothing to there is no adjustment to be made. Our what's it called? Our fine payable, which happens to be 32,500 naira as carrying amount, will still be 32,500 naira as tax base because there is no any information as touching maybe there is something to be reduced or there is something to be removed or not. So it will still be that. But don't forget, it is in bracket. It will be in bracket because we paid money out. And the reason why it is bringing minus sign like this is because we put bracket, like we put it in bracket. And don't forget, normally we used to remove carrying amount from tax base. So now this is minus already. This is minus already. So minus, like minus 32,500 minus 32,500 will definitely give you zero. Are we together? We definitely give you zero. Only give you zero. Then this particular one, I said it the other time that since the interest payable is on cash basis, it will also be what? The tax base will be zero. Are we getting it? So we have what? We have 10,500 as our what? Our temporary difference can either be taxable temporary difference or deductible temporary difference. If it is taxable temporary difference, we have what? We have liability. Are you getting me? But if we have what? If you have deductible temporary difference, we have asset. You can refer to my former video for the clarification on that. Now, our taxable temporary difference. Now, if you check this, you will notice that we have um freehold property. Let us write it out. Freehold property, which is 68,000, 68,300, 68,300. We also have we also have another figure. We put it in the bracket, which equipment is 22,500, 22,500. Don't forget, we are we as we say that they are taxable temporary difference because the carrying amount is greater than the tax base. The carrying amount is greater than the tax base. Which one is trade receivable is deductible because the tax base is greater than carrying amount, and then the interest received is taxable. Are you getting me? Because there is no opening balance, we don't there is no tax base. So we have plus 3,250. 3,250. We don't have any other taxable temporary difference. So we can actually put in the bracket like this. Do you get? Then let me add them together now. Let me add them together and put the figure here. Let me put the figure here. So let me just say equal to. So that is the total temporary taxable temporary difference. Then we can now calculate the deferred tax on this. So let us check this one, deductible also now. Deductible temporary difference. We have what? We have 16,715. We have 16,715. 16,750. Also we have 10,500. It is an asset. We have 10,500 plus 10,500. The reason why this one was actually minus was because we put it in bracket. So let us just remove the bracket since there is no because there is no what? There is no opening balance. So we have 10,500 there. Don't forget, the reason why interest payable is actually having zero is because it was on cash basis, and the tax base of such kind of item is what is zero. So if we minus zero from this, we have 10,500, which means that it is deductible temporary difference. So let us add it together and put this one in the bracket. So we have got to sign. So let us we can now say that deferred tax now. Deferred tax, it is 30%. So for the first one, you can just say that equal to 30% multiplied by 94,050. 94,000 and what? 050. And this one equal to sign. You have 30% of what? 27,250. 27,250. So do we get that? Is our what? That's our deductible. That's our taxable and deductible. Don't forget now, this one is taxable. The first one is taxable. The first one is deductible. Now, what are we going to do? We will subtract it from each other because one is like the tax authority is going to make a refund to us. Why? That taxable, it means we are going to pay the tax authority. So if the tax authority is making a refund to us and we are making a payment, we will set it off against each other to know the total amount we are expected to pay to the tax authority. So let us put this one in the brackets now. Let us just subtract it. Say you get, just subtract don't forget I told us that this one is a liability to be paid. You don't need to write this one in the exam. I'm just trying to write it. Why this one is an asset? This one is an asset. So let us set it off against each other to know what? To know the figure, the amount we are expected to pay to the tax authority, equal to 30% of what? 30, no, it's not 30%, sorry. 28,000 215 minus 8175. Do we get? So this is now our what? This is now our deferred tax that will be paid. Do you get like this? Like we have set it off now. The amount they are refunding to us, plus like subtract it from the amount we expected to pay to them. Then we have what? We have the balance of 30,500. So this is now our deferred tax for that particular year. This is the deferred tax for that particular year. This 20,040 is the deferred tax for that particular year. So it doesn't end there. We are expected to calculate the movement of deferred tax. So we say that movement of deferred tax. Movement of deferred tax. This is needed because we have a deferred tax that was actually carried forward. We're told that show the movement of deferred tax. Yeah, that's what we want to calculate now. Then I said, given the opening balance was what? 81. That's 8,100,000. So let us put a measurement value here. 8 million. Sorry, let us keep 30. Then we come to this place. We say that opening balance, which is what? 8,100,000 and 100. Do we get? Then the balancing figure that is going to income statement. It is always the balancing figure. Do you get? So now what is our closing balance? The closing balance happens to be 20,000 plus closing balance happens to 20,400. So we say that closing balance which is 20,400. 20,400. 20,040. Now, so that if this one is balanced figure, we want to find the one at the middle. What are we now going to do? We subtract this one from this one. So let us subtract it from each other. So 20,040 minus 81. What is going to give to us? 20,040 minus 8100. Sorry, I'm supposed to put equal to sign. Equal to. So this is our what? This is our balance income statement, like the amount to be transferred to income statement. I believe we all get it like that. So these are movement of deferred tax. Thank you so much. Thank you for joining. God bless you.